Let me tell you a truth nobody warned you about. Most retail investors don't lose money because the market is risky. They lose money because they behave like the market is a casino. And here is the uncomfortable part. The market is not designed to make you rich quickly. It's designed to transfer money from the impatience to patience, from the emotional to the disciplined, and from the amateur to the professional. If you have ever wondered why does it feel like the market always moves against me, this video will change how you see investing forever. Before we go any further, let me ask you one question. If investing is so easy, why do most people underperform the market? Why do mutual fund investors earn less than the funds they invest in? Why do 90% of traders lose money long term? The problem is not lack of information. The problem is human behavior. Today I will break down the real reason retail investors lose money. Reasons nobody puts in a YouTube thumbnail. Reason 1. They confuse activity with progress. Retail investors believe one dangerous lie. If I am active, I am productive. So they keep buying, selling, switching strategies, reacting to every headline, every candle, every tweet. But here is the truth. The stock market does not reward activity. It rewards patience. Professionals make money by waiting. Retail investors lose money by doing something. When doing nothing was the correct decision, in investing, boredom is often a sign you are doing it right. If you feel busy in the market, there is a high chance you are also bleeding money. Reason 2. They buy stories, not value. Retail investors don't invest in business, they invest in stories. This company will change the world. Everyone is talking about it. It already went up. It must go higher. By the time a story reaches the retailer investor, smart money has already positioned itself. The market doesn't care how exciting a company sounds. It only cares about cash flows, valuations, and expectations. When expectations are too high, even good companies become bad investments. A great company does not automatically mean a great stock. Reason 3. They panic at the worst possible time. Let's be honest, retail investors buy when they feel confident and sell when they feel scared, unfortunately. Confidence appears near market tops and fear appears near market bottoms. So they buy high, panic during volatility, and sell exactly when patience was required. The market doesn't punish bad people, it punishes emotional decisions. Volatility is not a risk. Reacting emotionally to volatility, that's the real risk. Reason 4. They expect fast money. Retail investors secretly believe the market owes them fast returns. A few months without profit feels like a failure. But wealth is built slowly, quietly, and painfully. The stock market is one of the few places where doing nothing for long periods can outperform constant effort. The biggest returns often come after long period of frustration. If you are not willing to wait, you are volunteering to fund someone else's patience. Impatience is the most expensive habit in investing. Reason 5. They don't have a real plan. Most retail investors don't have a strategy. They have opinions, no entry rules, no exit rules, no position hedging, no risk management, just hope. And hope is not a strategy. Professionals don't predict, they prepare. They accept losses as a part of the game. Retail investors take losses personally. The big truth nobody tells you. Here is the truth most people don't want to hear. The market is not against you. You are often against yourself, your fear, your greed, your impatience, your need for excitement. If you don't master your psychology, no strategy will save you. Investing is less about predicting the future and more about controlling your reactions. How winning investors think differently. Winning investors think differently. They focus on process, not daily profits. They accept volatility as a normal. They wait for high probability opportunities. They they protect capital first. They understand that missing opportunities is better than forcing bad ones. They don't try to be right every time. They try to survive long enough for compounding to do its job. Final wake up call for yours. If you remember only one thing from this video, remember this. The stock market is not a shortcut to wealth. It's a test of discipline. Most people fail not because the test is hard, but because they refuse to change their behavior. The market rewards patience, humility, and consistency. Everything else is noise. If the video made you uncomfortable, that's a good sign. It means you are finally seeing the market clearly. If you want more honest, no hype, real investing psychology, subscribe to this channel. I don't promise quick money. I promise clarity, discipline, and a mindset that actually survives the market. Like this video if you have ever made an emotional mistakes. Comment below what is the biggest mistake you have made in the market. And remember, the market doesn't reward intelligence, it rewards behavior.